So let's start with the session now, everyone. So this is going to be our first session. So I think everyone have joined the orientation session in which we discuss about how many questions will be there and how the paper is going to be there. We have discussed about the blueprint of the FAR paper. So before I just start with my syllabus, I have to just take any of your doubt, anything you want me to discuss now before we start, or anything you have any doubt related to syllabus or any particular thing you want to ask.
Sir, I have a doubt.
Yeah, yeah, please.
Actually, I've just given my second year exams of BCom and I just got promoted in the third year. And I'm doing a 4 year BCom degree. So I'll be taking my exams after 2 years. And the GLEM portal is only valid in 2 years. So I wanted to know that when should I get my GLEM access and how should I utilize these 2 years?
For Glyme access, I think VGLD team will help you out. But what I think, like Glyme access will remain valid for not, it will remain valid for most probably for 18 or 24 months. So it's not better if you just take the access now. It's better that you just go through to the sessions, you just practice the questions, what we are doing in the class. And most probably you can take the help from the VGLD team as well. They'll definitely help you out for this. And most probably, like when it comes to examination, like if you want to, so most probably your registration will be done like, as you are saying, after 2 years. So, see, what I would suggest as of now, don't take the Glyme access, because if you take the Glyme access before you give your exam, it will be lapsed. So it's better if you take it like after 2 years only, once your registration is being, or you can take it even after like next year also, like because most probably you are eligible for registering with CPA, and ultimately you are ready for your exam as well. So but I'd suggest you before taking any action, any decision, just connect with VGLD team as well. They will give you the exact expiry period as well, that how many time, in how much time it will get expired. And accordingly, you can take your action.
Okay, sir. Am I not too early for this, or it's okay that I'm studying 2 years before?
Yeah, that's fine. If you're studying, that's fine. Ultimately, you'll get the time for revision and everything. Even you can connect whatever the syllabus we are doing, you can connect it with what you are doing in the college as well. You can connect both the syllabus as well. But only the text is something that is going to be different for you. Other than that, far and odd is going to be very similar to what we do in India as well.
Okay, sir. Thank you.
Yes, any other doubt?
I'm Renu. I have
Yeah, yeah.
one question. Actually, I have a VGLD registration, which was done in 2024, and
Okay.
I'm planning to appear for exam now in November. So I don't have the GLAM access. I think what I have is a Becker access, because at that time they were doing through the
Yeah,
Becker.
yeah, yeah, yeah.
So
I
how
think
is it
Becker,
different?
see, only what we are doing here in the class from the Glein, it's most probably the syllabus is going to be changed. Other syllabus is not going to be changed. It is just some chapter which is given on the first number in Becker, it will be given on third or the fourth number. Only the sequence of the chapters is going to change.
So is it okay? I can
Yeah,
continue
yeah,
my
yeah,
practice from the Becker,
yeah,
because
yeah,
that
yeah,
time it was
definitely.
said. Yeah. So in
Definitely,
terms
you
of
can.
question preparation and the practice test, Becker is fine.
Yeah, Becker is fine in that case.
Okay. And this post your classes, which is going to end in September, you will be doing that stimulation-based question sample.
Yeah, yes. Most probably, these simulation and everything we will be doing the post classes as well and with the classes as well. So don't worry about that. So we'll be doing it with the classes as well, like most probably in a weekdays or like one session in the evening, 9 to 10 or anything like that. We'll accordingly discuss in the class what should be the right time when everyone will be available or within the weekends only. We'll keep one or two sessions with our classes only in which we can practice the simulations and everything. But for simulation, I always say when I usually take the simulations, I'll prefer that first we complete few chapters, then we take the simulations because in simulation we will find out a lot of those topics as well, which there is a chances we have not covered yet.
Okay.
So it requires the knowledge from a lot of chapters combinedly. So that is why I always prefer it. If we do it afterwards, then most probably it will be good.
Okay.
Any other issue? Any other point? Okay, so let's start with the first chapter. In the first chapter, we will be discussing about the financial statements. So this is going to be the very first chapter we are going to start now, which is financial statements. Anyone have an idea what are the financial statements? How many financial statements are there in total?
Balance sheet, sir.
Balance sheet,
P&L, cash
profit and loss, cash flow. Okay. Yes, Renu, which five financial statements we have? Okay, statement of changes in equity. So the first is statement of profit and loss. We also call it as an income statement. The second is statement of financial position. We also call it as a balance sheet. And the third one is statement of changes in equity. And the last one is cash flow statement. So mainly we prepare four financial statements. One is statement of profit and loss, which we call it as an income statement as well. And we have see, if we have a comprehensive items as well, then we prepare the statement of comprehensive income as well. But that is something dependent on whether we have a OCI items or not. So that we will discuss. But usually either we prepare the income statement or we prepare the statement of comprehensive income. The third is statement of changes in equity, where we show the reconciliation of opening balance of equity and the closing balance of equity. And finally, we have the cash flow. So what is the main objective why we prepare the financial statements?
To know the financial position at the end of period.
Okay. To know the financial position.
Like for assets, liabilities, and equity.
Okay. So I think this is only this is something we get an idea from the balance sheet. And what is the use of other statements?
To know about the expenses and gains and the losses for the respective period.
Okay,
helps us
great.
getting to know the inflow and outflow of cash.
Okay. That is for the cash flow statement. Okay, so great. So ultimately, financial statements is being needed by the users by the stakeholders, by the shareholders of the company, by the customers, by the debt providers. Everyone need the financial statements of the company. Like the stockholders mainly want to know how much profit the company is generating, because ultimately, accordingly, they can expect the capital appreciation or the dividend on the stock. Balance. So ultimately, next is debt providers. They want to know whether the company is able to pay off their debts on time. Then there are certain terms as well which is covered under debt covenants, debt restrictions. So that is also they require to fulfill. Then customers need it because they want to know whether the customer will whether the customer will give the money on the regular basis or not. So multiple other reasons are also there why the financial statements are being needed. So use of the financial statement will be changing from user to user. So this is something we are going to discuss in this particular chapter, first chapter. That is balance sheet, that is statement of income, comprehensive income, statement of changes in equity, and special purpose framework. So multiple financial statements we prepare. Like we prepare the financial position. So financial statement help us in knowing the financial position at the end of the period. So that is something we get an idea from the balance sheet. So why we prepare the financial statement? Why we prepare the financial statement? These are the multiple reasons why we prepare it. Like when we prepare the balance sheet, it will help us in knowing the financial position at the end of the period. What is the financial position of the company at the end of the period? Means by looking at the balance sheet, we can say this is the amount of assets, liabilities, or equity of the company. So multiple elements we have from the balance sheet. That is something we get an idea from looking at the balance sheet. Next is comprehensive income. Comprehensive income means we are mainly elaborating the financial performance of the company, how the company is performing, how well they are generating an income. So that is something is a comprehensive income. So it includes the net income and other comprehensive income. Then how much money is being invested by the owners and how much money is distributed to the owners.
Excuse me,
And
sir.
that is something, yeah, please.
Sir, please a little bit more elaborate comprehensive income, sir.
Yeah, I am explaining it. Okay, let me explain this first, then I'll explain comprehensive income again. So investment by and distribution by the owners. So this all the things we have a chapter for each and everything. Like we have a chapter for balance sheet, we have a chapter for income statement, we have a chapter for equity and the cash flow. All these chapters are given separately in this book. So we'll be discussing each one of these topics separately as well in very detail. But I'm going to give you the quick glimpse of what we are going to do in the financial statement. So here we have the investment by and distribution to the owners. So how much money is being invested? Money is being invested means how much new common stock is being issued, or how much money is going to be distributed to the owners, means when the company earns the income. So what happened? Whenever the company earns the income, some part of the income will be paid as a dividend. So whatever is being paid as a dividend, it is considered as distribution to the owners. So investment by and distribution to the owners. So I'm explaining this comprehensive income again. So comprehensive income means overall income. Some income should be included within the income statement. Let me say most of the items related to income and expense will be recorded in the income statement. So that is something like sales, operating expenses, cost of goods sold, then other non-recurring expenses like interest expense, interest income. That is something recorded in the income statement. And when we make an adjustment of this, we'll get the net income. But some items are there that is not included within the income statement. So those items should be recorded as a other comprehensive income, as a part of other comprehensive income. So those items we'll discuss in the coming part of the session. We'll discuss about those items. So that should be recorded as a part of other comprehensive income, just like available for sales, uh, unrealized gain or loss on the available for sale debt securities, like I would say any translation gain on the financial statements, or cash flow hedge gain or loss on the cash flow hedge instruments, any post-retirement obligations, any uh, changes in the value of that. So that will all lead to the other comprehensive income. So that should be included as a part of other comprehensive income. And whatever we generate out of income statement and whatever we generate out of a statement of OCI, combinedly it is known as comprehensive income. Combinedly it is known as comprehensive income. When we combine both of these incomes, it will become a comprehensive income. Is this clear now?
Yes.
We'll discuss in more detail what all items will be included in OCI. We'll discuss in more detail in the coming part of the session. Next is cash flow during the period. Cash flow during the period means how we'll get a cash flow during the period? Any idea?
Through operating and investing activities.
Okay. Great. So whenever we prepare the cash flow statement, so cash flow statement help us in knowing what all cash we are generating from the cash from operating activities, how much cash is being invested, or the cash we are generating out of investing activities, or how much inflow or outflow will be there from the financing activities. That's why we prepare the cash flow statement. And cash flow statement is considered as one of the most important statement. Why? Because like when I'm looking at the balance sheet, when I look at the current year balance sheet, I'll get the cash at the end of current year. When I look at the previous year balance sheet, I get the cash at the opening, cash in the opening. And let me say cash for the current year is, let me say $300,000. And for the previous year, it is $250,000. So if you can see, the cash balance is increasing by $50,000. But as a user of financial statement, I want to know why the cash is being increasing. So that is the reason company prepares the cash flow statement. So cash flow statement ultimately help a user in knowing from where the company is generating the cash. More cash generated from operating is good for the company. If we are having more cash from the financing activities, it is of no use because the company is taking a loan, company is issuing the fresh equity just to generate the cash. But if the cash is generating out of operation, it is always look good. It's always considered as the good thing about the company. Why? Because the company do not generate only once. Company, if it is generating from operations, it will be generating every time. It will be generating every quarter, every day. So it is good for the company. Is this clear?
Yes, sir.
What about others? Everyone, I need a quick thumbs up. Great. So now the next very, very important thing with which most of the people do not consider, like while preparing the financial statement or while looking at the financial statement, is notes to the financial statement. Notes are very, very important. Why? Because without notes, I would say the financial statements are not complete. So whatever the information that is not presented on the face of the financial statements, that information will be reported as a part of notes to the financial statement. Like I'm taking one example. In the financial statement, we never find out the depreciation expense or how we calculate the depreciation expense. We never find it out. Or which method of depreciation we are using, will not find it out. So if you want to check how much depreciation the company have calculated or which method the company have choose, how they have calculated, so that all you will be finding out within the notes to financial statements. If you want a supplement or you want to further explain information on the face of the financial statement, you have to look to the notes. So that is something considered as an additional information which is not being presented on the face of the financial statement. It's an additional information. Uh, just to explain whatever extra information that is required as per GAAP, uh, that is not presented on the financial statement faces, that should be presented in the notes. Just like we never provide the calculation or the computation on the face of the financial statement. So all those computations will be provided in the notes. So I would say it provides the necessary context and granular detail, means point to point details, that numbers alone can't convey. Means if I'm saying a depreciation is 50,000, I'll give you that information. What understanding you will be having out of that depreciation? No understanding. But if I show you the entire computation, I'll show you which method we are using, what is the life of an asset, everything. It will give you the better idea. Then notes to financial statement also provides what accounting policy is being used, which method of valuing the inventory we have used, or any other thing that is required as per GAAP should be presented within the notes to the financial statement. So we are disclosing what specific methods we are following, disclosing the specific methods. Estimates. Like if I'm saying my useful life of my asset is 10 years, why it is 10 years? How you have estimated? And the frameworks. That the company used to prepare the statements. And the last is other disclosures required by GAAP. So we are ensuring that compliance should be mandatory. Whatever the other disclosures are there, we have to make sure that compliance with the mandatory reporting standards will be compulsory. It's mandatory. and it is required for the transparency. So just take one example now. There is a company named as Apex Manufacturing Incorporation. It is preparing its financial statement using GAAP. Okay. And there's a company named as Apex Manufacturing Company. Okay. And it is preparing the financial statements, its annual financial statement using GAAP. Now, on the face of the balance sheet, Apex Manufacturing Company have presented the property, plant, and equipment balance as net $5 million. If suppose I'll just tell you that this is the value of PPE, I don't give you any other information. How satisfied you are? I think as a user, I will never be satisfied. Why? I will be satisfied because suppose I'm an investor. As an investor or as an auditor, has no idea what $5 million actually represents. I don't get that idea. So ultimately, the first thing, supplement or further explain information. So in the supplement or explain further information, ultimately a note is being prepared. Note by the name of PPE is being prepared where they will be showing the bifurcation of all the assets. Like I have a land worth $1 million. We have a building, we have a machinery, we have a gross PPE. Then we subtract the accumulated depreciation and we get the net PPE. Ultimately, the entire computation will be included in the supplement information. Like we will be preparing a note 4, let me say. And with its note 4, we'll say that these are the PPE balances. Like we have a land worth $1 million. We have a building worth $3.5 million. We have a machinery and equipment worth $1.5 million. And the gross PPE we have is a 1 million plus 3.5, that is 4.5 plus 1.5 as $6 million. Then we subtract the accumulated depreciation, that is $1 million. And this is how I get $5 million as a value of PPE. That is the net PPE I get. This is how we get an idea. Then in the accounting policies, I will be specifying that I'll be specifying the summary of accounting policies like depreciation method. I'm following a straight line method. Useful life for building life is 10 years, 20 years. For machinery, the life is 5 years, 10 years. So this is something I'm explaining. Then in the other disclosure policies, like if I have taken any collateral, I have taken any loan on any particular asset, that is something being explained. Or let me say, company have entered into any agreement to purchase any particular asset in the upcoming year, that is also something going to be included within the other disclosures required by the GAAP. Guys, you can quickly go through to this. Guys, I'll be back in 1 minute. I'll be back in a minute, please. Let's proceed, everyone, now. If there is any doubt in this point, just let me know. We can discuss it. Or guys, you can give a thumbs up if you're fine with this so that we can start with the next point.
Sir, I have one doubt.
Yes, please.
In the book, it's written notes may not be used as a substitute for recognition in the statement. What does this line means?
Can you please repeat once again?
It's written notes may not be used as a substitute for recognition in the statements.
Yes. What does this mean? Whatever you have to recognize, that is something compulsory. You can't say that I have included in the note, so that's why I'm not including in the financial statement. Let me say I have to show the PPE value, property, plant, and equipment. That is something I have to include it in the balance sheet. I can't say that I've included in the notes, so I don't need to recognize it in the balance sheet. I have to recognize. So whatever is being shown within the financial statement on the face of the financials, so I can't say that if I have included that within the notes, that should be considered as something we have already recognized within the financial. No. In financial, I have to recognize separately. In the notes, I have to recognize separately. Note is something which is explanatory part. And financial statement is something that is required as per GAAP. It's something required as per law, something required as part of a compliance. So that is a different thing. Clear?
Yes, sir.
Okay. Now, we have this basic accounting equation. Can anybody please explain this equation? What does this equation means?
It means that resource structure is equal to our financial structure.
Okay. Anyone else?
Sir, it actually shows the balance sheet statement in which there are assets are always equal to liabilities. When we analyze the balance sheet, so it is always equal. Both of the sides are always equal.
Okay. More responses, please. I think this is a basic thing. Total assets are funded by the debt and equity. Okay. Great.
Is
Yes.
used to find the net worth of the company.
Net worth of the company. Okay. Yes, we can say that. So each and everything have its own meaning, on a reason of being in the balance sheet. So the first thing we have is the assets. So what are the assets? So asset is nothing, it's an economic resource. It's a resource which the company have. It is an economic resource, and this economic resource is considered as, I would say, that is something being used in generating any revenue in the future, any cash flow in the future, that is being help a company generating the cash inflow in the future. So it's an asset. When I'm saying a liability, liability is like an obligation of the company. So as part of, like, whenever we need an asset, in any way, the asset is being financed either through the liabilities or through the equity. Let me say, suppose I'm an owner of the business. So when I'm contributing the money, I'll be contributing in the form of cash. So cash account debit, capital account will be credit. So equity is something considered as a capital. So so here I'm funding the asset in the form of cash, and that is being funded by the equity. That is funded by the capital, by the owner. In the same way, the assets can be funded by the loan as well. Like we take a loan. Let me say we have taken a loan to buy a machinery. Machinery account debit, notes payable account will be credit. We have taken a loan to buy a machinery. So in that case, asset account will be increasing and liability account will also be increasing. So asset is most probably funded either through liabilities or through equity. So that is why if the change is coming in the asset side, equal change will be coming in the liabilities and equity side as well. So that's why I always say asset is equal to liabilities plus equity. Just 1 second, please. Okay. So when I'm saying assets, asset is nothing, it's an economic resource which generates benefits to an organization, to an entity in the future. Then we have the liabilities. It's an obligation on the company. And when I'm saying equity, equity is considered as a residual interest. Why we call it as a residual interest? Because when you calculate the value of equity out of assets, when we pay off the liabilities, whatever is being left is for the equity holders of the company. Whatever is being left is the remaining interest in the assets of the company. After we make the payment to the liability providers of the company, after we make the payment to the liability holders, whatever is being left, that is the equity of the company. So whatever the remaining interest left in the assets of the company, that will be for the equity holders. That's why we say it's a residual interest. It's a remaining interest in the assets of the company. Any doubt within this point? So as we have discussed, I'm just repeating it once again. So basic accounting equation includes all the items that are considered as the elements of the balance sheet. So these are something considered as the elements of the balance sheet: asset, liabilities, equity. So asset is something valuable the company owns. Liability is an obligation. Liability is something the company have to pay. Equity is always considered as the remaining interest or residual interest in the assets of the company after we make the payment of the obligations. So I would say this basic account. So balance sheet also explains the relationship between the assets, liabilities, and equity. So how we say that there is a relationship will be there? Like it clearly states that how much of the assets being financed by the liabilities and how much of the assets will be financed through the equity. It also help any particular user to just calculate, just to find out the liquidity of the company, how flexible the organization is towards their finances, and what all is the risk of finances lies with the organization, with the entity. It is something an organization get an idea from the basic accounting equation. Is this fine? Okay. So this is how the comparative statement of financial position looks like. So we have the assets in one side, we have a liabilities and equity in the other side. So we have the assets in one side, we have the liabilities in other side, liabilities and equity. So once we start with the assets will be shown in the liquidity order. More liquid the asset is, more liquid an asset is, it have to be shown initially. So we start with the cash and cash equivalent, we start with the debt securities, investment, AR, note receivable, inventories, prepaid expenses. So this is how the asset looks like. This is how the assets looks like. Then we have a non-current asset in which we have a long-term investments like equity method investment, we have a PPE, we have a goodwill. These are the non-current assets. Then we have a liabilities again. In the liquidity order, we have the liabilities. In the liquidity order, we have a liabilities of the company. So it starts with the AP, then any accrued interest on the note that will be included here, any long-term debt. Out of the long-term debt, how much debt is going to be due in the coming future. So current maturity of the long-term debt, accrued salaries and the wages, any income tax payable, these all are the current liabilities of the company. Then we have a non-current liabilities in which we have the bonds payable, like a long-term debt, any long-term notes payable, any employee-related obligations, any deferred income taxes, that is the part of it. Then we have a equity. In the equity, we have a common stock. So common stock, some items name has been changed. So common stock is same as the equity share capital in India. And additional paid-in capital is same as the security premium. So common stock, it is same as the equity share capital. And it is same as a security premium. Then we have a accumulated other comprehensive income and we have a retained earnings. So in US, mainly when I'm using the word common stock, it is same as equity share capital. When I'm using the word preferred stock, it's same as preference share capital. Let me know if any word, any item that is not being cleared, because most of them we are going to discuss in the coming part of the session. Like for deferred income taxes, we'll discuss once we come to income tax accounting chapter. Then employee related obligation, I think we have nothing to do with that. Any other item, guys, if you want me to discuss?
Sir, you said assets and liabilities should be shown in the sequence as per liquidity wise. That liquidity
Yeah.
wise is current assets, non-current assets, Or within current assets also we have to show as a liquidity wise.
Within the current assets also, we have to write it in the liquidity basis.
So then how we make a difference? See, suppose in current liabilities, accounts payable is the highest liquidity and the accrued salaries is the lowest liquidity. How it is defined or something like that?
See, most probably, we always say that accounts payable is going to be paid at the earliest, because once you buy the goods on credit, you have to pay at the earliest.
That's
It's
fine.
mainly comes with the sense.
Now current maturities
Yeah.
of long-term debt and accrued salaries and wages and income tax payable. Which one should be the more these things like liquidity wise?
See, it's totally dependent on the assumption of the company, most probably. I can say that. It's totally dependent on the assumption of the company. So accounts payable, I can say, but for accrued interest or note, whether it should be paid in 2 months, 3 months, it depends on companies.
So it can be interchangeable, right? It can
Yeah,
within the current liabilities, it can be on the sequence can be changed.
yeah, yes, sequence can be changed. But in current assets, I don't expect the sequence to be changed. I think it will remain same. Mostly AFS debt securities can come like below as well, but
Okay.
most probably the sequence most probably remains the same.
And sir, one more thing, this one notes receivable. I'm not getting this term. What it is? Notes receivable.
Okay. So you are clear with AR,
Yeah.
account receivable. What will be
Yes. Yes.
that?
Yeah, it's a kind of a sundry debtors, trade debtors, what we call it over here,
Absolutely.
bills receivable, etc.
Account receivable is same as the debtors. Like
Correct.
whenever we sell the goods on credit,
Mhm.
we call it as AR. But when it comes to note receivable, so
Mm.
let me say I sold the goods on credit, but I get the promissory note signed. Most probably the promissory note
Yes.
does not involved in the sales, but
Mm.
if promissory note is being involved, I'm getting the promissory note signed from the customer. So in that
Mm.
case, instead of calling it as a account receivable, we call it as a note receivable. But most probably note receivable comes within the non-current asset, most probably. But I don't know why they are showing it in current asset. But most of the cases it will be coming in the non-current assets. Why? Because promissory note is being involved when a longer period is being covered. And most probably in the note receivable, we are asking for the interest as well. Mainly it will be like 5%, 6%, 10%. Interest is going to be charged from the customer for whatever the credit period we are allowing them. And in this, promissory note is being signed, and that's why we call it as a note receivable.
Okay. And sir, this LC and bank guarantee comes under notes receivable.
Can you please repeat once again?
Letter of credit and these things, bank guarantee also comes under notes receivables.
That is something you can say, but it's in more practical terms. You can include it as a part of note receivable. When you are getting a guarantee in any way, like from the bank, from anywhere, you are getting a guarantee that you'll get the payment on time. So that should be the part of note receivable.
Thank you.
And most probably in the note receivable, the interest is also going to be charged from the customer.
So what's available for sale debt securities?
Can you please repeat once again?
What is available for sale debt securities?
Okay. See, whenever I'm doing an investment in the debt securities means I'm making an investment in the bonds of other companies. Okay. So ultimately, we can make an investment in three ways. The first is the trading debt securities. When I buy for the very, very short term, I call it as a trading debt securities. The third one is HTM, held to maturity. Means most of the time, the bond, not most of the time, every time I would say the bonds have the maturity period. Like bonds having a maturity period of 20 years. So I would say if I'm keeping the bonds till maturity, till 20 years, then it is categorized as held to maturity. And the third type of debt securities investment is AFS, available for sale. Means I'll neither have an intention to keep it in to sell it in very short term, and neither I am having an intention to keep it for the long term. I have an intention to keep it for a specific amount of time so that I can generate the effective rate of return what I'm expecting. So that is something known as a AFS debt securities, available for sale.
So we can sell it whenever we want.
Yeah.
So like we don't have to wait till its maturity period, or we don't have to sell it immediately when we purchase. We can
Yes.
sell it whenever.
Yeah. We can sell it like in 2 months, 3 months, 4 months. Whatever the time we have to wait, we can wait for that time and we can sell it afterwards. So now let's move to the next point. Okay. Can anybody please explain what are the current assets?
Which can easily be converted into cash.
Okay.
Economic resources which are available or which can be converted in the monies within 1 year.
Okay. More answers, please.
Assets that can be easily converted in cash, sir.
Assets that can be easily converted into cash.
So short-term debtors that can give money back to us in within the period of 1 year.
Which are due to be realized within 1 year. Okay. Absolutely correct. I think everyone is correct. When I'm saying the assets that can be converted into cash or that can be realized within the period of 1 year or within one operating cycle. What is an operating cycle?
In
So
which
operating cycle can be more than 12 months, or is it always remains within 12 months? Yes. First, what is operating cycle?
the operating cycle is a tenure in which the business operates. It can be any kind of financial year, or it can be a calendar year in which the organization performs its functions. So
Okay.
technically, the operation cycle is usually within the 1 year.
Okay. More answers, please.
Sir, operating cycle can be the period in which the goods can be converted from raw materials to finished goods. It can be more than 12 months.
Okay. More answers I'm expecting.
I think it can be less than 12 months, sir. Depends on the company's operating activities.
Okay. So whenever I'm saying operating cycle, what all will be included within the operating cycle? When I'm using the term operating cycle, what does it starts when company purchases the raw material, then company converts it into finished goods. Then they
Still
convert
it.
finished goods into sales. Then they convert, then they collect the payment from the customer. It ends here. So it starts from purchase of raw material, then collecting the payment from the customers. This is something considered as an operating cycle. So whatever the time it will be taking, sometimes it takes more than 12 months. Sometimes it takes more than 12 months in converting the raw material into cash. Like if we are dealing in those products which take lot of time in converting into finished goods, if we are dealing in those goods, then definitely the operating cycle is quite large. It can be of more than 12 months as well. So that is the reason we always treat the inventory as a current asset. We never treat it as a non-current asset. Suppose if you have the inventory and you are keeping the inventory with you like for 1.5 years, still you don't treat the inventory as your non-current asset. Why? Because it is the part of an operating cycle. So if operating cycle is even of 1.5 years, we have to treat those assets which are considered as a part of operating cycle, that should be considered as the current assets. So in any case, if operating cycle is of 1.5 years and any asset is going to be converted into cash within 1.5 years, so we consider it as a part of current asset. So that's why it is written cash and other assets or resources commonly identified as reasonably expected to be realized in cash or sold or consumed during the normal operating cycle of the business. Just a simple thing. मैंने raw material खरीदा. I just convert it into finished goods. Then I just sell it and we receive the payment from the customer. So whatever the time it takes, so it includes inventory conversion period. It takes receivable collection period. When we combine these both the periods, it will be known as operating cycle. Yes, I think somebody is asking the doubt.
Sir, can it be less than 1 year?
Yes, it can be 2 months, it can be 3 months.
So debtors outstanding more than 3 years would be current assets or non-current assets,
It's always a current asset.
like stock, as you said.
Yes.
Okay.
So I have one doubt.
Yes, please.
If let's suppose the operating cycle is 6 months and the asset is realized after 6 months, so will it be considered current or non-current?
Can you please repeat once again? Sorry.
If the operating cycle is 6 months and the asset is realized after the 6 months time period of the operating cycle, the asset will be
So
considered
it
as a
can go
current
up to 12 months, whichever is longer. Either operating cycle or 12 months, whichever is longer. If operating cycle is 6 months, then we have to take 12 months period. Means if it is converted within cash in 12 months, then it's a current asset. Next is the non-current assets. So what are the non-current assets? Those which are not qualifying as a current. Those assets which are not qualifying as a current asset are the non-current assets, like investment and the funds. Like investment and the funds. And if we are keeping it for more than 1 year, so if you are keeping it for more than 1 year, then it's a non-current asset. So like investment and the funds, PPE, like intangible assets, other non-current assets, these all will be considered as a non-current assets. Anything that is not clear till this point, just let me know.
Intangible assets like, for example, goodwill type of.
Yes, intangible assets like patents, like goodwill, anything.
So are available for sale securities current or non-current?
See, available for sale till the time nothing is specified, it's a non-current asset. If it is clearly specified that it is going to be realized within 3 months, within 1 year, then it's a current asset. But if nothing is specified, we always treat it as a non-current asset. Trading debt securities, trading equity securities, it is always current because it is always being sold in the near future. But when I'm saying other than trading securities, whatever the investment we have, it is always treated as a non-current assets, not a current asset. Yes, let me know if anyone have any doubt here.
Sir, what will be included in other non-current assets?
So a lot of things, mainly when I'm using the word other non-current assets, so whatever the assets that is not being considered as a part of whatever the assets we have considered here, like most probably except PPE, except intangible assets or except investments like deferred tax assets, any long-term loans, any long-term advances are there, any long-term prepayments are there, even unamortized bond issuance costs. See what happened. I would say just like deferred tax assets, these are the part of deferred tax assets. We can have long-term prepayments. We have just like prepaid assets. We usually treat it as a part of current asset. But if the prepayment is for the longer period of time, like we paid an advance expense for more than 2 years, more than 1 year, then it so next 1 year it is treated as a current asset. For more than 1 year, it will be treated as a long-term asset. So it is the part of other non-current assets. Then we can have a long-term advances, we can say. आपने किसी को advance पे पैसा दे दिया, and that is for longer period of time, so it will be covered here. But usually I can say whatever is not being the part of investment and funds or PPE or intangible assets, it is the part of other current assets.
Okay, sir.
So guys, before I move to the next point, current liabilities or non-current liabilities, we can take one break, a 10-minute break, and after the break, we'll start with the current liabilities and non-current liabilities. Okay, let's take a break. Let's start now, everyone. So everyone is available, I think. Okay, perfect. So we are discussing about the current liabilities and the non-current liabilities. So current liabilities, just like we discuss about the current assets that can be converted into cash within 12 months. In the same way, current liabilities is something that needs to be paid off within the next 12 months are the current liabilities. So they also provide one more definition here. Obligation whose liquidation is reasonably expected to require the use of existing resources properly classifiable as a current assets or the creation of other current liabilities. So when I'm saying any obligation whose liquidation is reasonably expected, any obligation to pay off, any obligation that is required to be paid off out of the current assets, or that requires creation of other current liabilities, is something considered as a current liabilities. But mostly I would say koi bhi liability, if you are able to pay off within the next 12 months, it's a current liability. Just a simple thing, agar aap ek liability within 12 months, if you are able to pay it off, it's a current liabilities. And if you are taking more than 12 months to make the payment of the current liability, it is a non-current liability. But one thing is very, very important in terms of current liabilities. Let me take one example here. Suppose you have taken a loan. Let me say the loan is of $1 million. Okay. And this part of the loan, you have to pay equally every year. So, and the time of the loan is, let me say, 5 years. So whatever the amount you are going to pay off every year will be treated as a current liability. So like if I'm dividing it by 5, so 200,000 is going to be paid off every year. So 200,000 will be treated as a current liability and other 800,000 will be treated as a non-current liability. Again, in the second year, when you pay off another 200,000, then 200,000 will be treated as a current liability, another 600,000 will be treated as a non-current liability. So whatever the liability that is going to be paid off within the next 12 months is treated as a current liability. Otherwise, it will be treated as a non-current liability. We'll take one more example. Let me say you have taken a loan. An entire loan will be paid off at the end of 5th year. Entire loan will be paid off within the next at the end of 5th year. So at the end of 4th year, when we prepare the balance sheet at the end of 4th year, this entire loan will be treated as a current liability. But for the next 4 months, 4 years, it will be treated as a non-current liability. But at the end of 4th year, it will be treated as a current liability. So current liabilities, we have to take care about one thing. If only 12 months is being left, then whatever the loan you have is treated as a current liability. If more than 1 year is being left, then it will be treated as a non-current liability. Is this clear? When it comes to non-current liabilities, those liabilities which are not the current liabilities are the non-current liabilities. So non-current notes and the bonds. Then any liability related to leases, because lease is mostly taken for more than 1 year. So it's a non-current liability. Yes, Renu, I'll take one example for this as well. Next is post-retirement benefit obligations. 1 second. So first of all, I'm taking the example of post-retirement benefit obligations. What will be that? Post-retirement benefit obligation means ultimately when I'm saying post-retirement benefit obligation, so just take one example. Suppose there is a company named as A Corporation. it provides a post-retirement healthcare benefits for its employees. And the company is expecting that in the future, the liability is going to be $2.5 million. So whatever the benefits they are going to provide in the next 5 or 10 years, it will be treated as the post-retirement benefit obligations. Let me say the company have agreed that they will provide healthcare benefits for the next 10 years. So whatever the healthcare benefits they will be providing in the next 10 years is treated as a post-retirement benefit obligations. Now, I'll be taking the example of this creation of other current liabilities. Let me say there is a loan. Okay. Loan worth $50,000. And this loan is going to be paid off as on December 31st, 2025. And due date to make the payment of this loan is due date to pay this loan is like in, let me say, 2nd February 2026. So it will be represented as the current liability on December 31st. Okay. Now, this liability is going to be paid off. To refinance this loan, let me say, to refinance this loan, company have taken another loan that is going to be paid off on 30th November 2026. So ultimately, let's understand this question, what is being specified here. Like we have taken a loan worth 50,000. And we have not taken the loan. This is the loan that is due on, that is payable on December 31st, 2025. But the due date to pay on for this loan is 2nd February. And ultimately, to make the payment of this loan on 2nd February 2026, what we have done, we have refinanced this loan, and this loan have been refinanced by taking another loan that is going to be paid off in the next 12 months. So it will be treated again as a current liability. Now I want to add one more thing here. Company have taken another loan that is paid off on 30th November. I'm adding one date more. That is going to be paid off on 30th November 2028. एक बार तो हमने लोन को रीफाइनेंस किया है by taking another loan that should be paid within the next 12 months. So it is a current liability. But I'm taking another loan which is going to be paid off on 30th November 2028. That is within 36 months that is going to be paid off. If this is going to be the case, then this current liability will also be treated as a non-current liability. If any liability is going to be paid off by taking another current liability, then it is a current liability. But if any liability is going to be paid off by taking another liability that is due in more than 12 months, then it will be treated as a non-current liability. So even if this current liability, this is considered as a current liability 50,000, but still will not take it as a current liability, will take it as a non-current liability, because जो एक नया लोन ले रहे हैं उसको पे ऑफ करने के लिए that will be paid off in the next 3 months, 3 years, sorry. This is the concept of refinancing of the loan. अगर कोई भी लोन अगर आप रीफाइनेंस कर रहे हो बाय द शॉर्ट टर्म लोन, देन इट्स अ करंट लायबिलिटी. But if you are refinancing any loan with a long term liability, then it's a non current liability only. It's not a current liability. Is this clear? Yes, Renu, is this clear? Vallabh, is this clear? Others, please. Swati, Sumit,
Yes, sir.
Simranjeet. Okay, great. Now, we are moving to the next very, very important point, equity. So normally, as we have discussed, there are three sides of the balance sheet is there. One is the asset side, second is the liability side, and the third is the equity side. One is the asset side, second is the liability side, and third is the equity side. Asset and liability side we have already seen. Now we are coming to the equity side of the balance sheet. So equity side is nothing, it's a residual interest in the assets of the company. So out of the assets, when we pay off the liabilities, whatever is being left is for the equity holders of the company. So it's a residual after total liabilities are subtracted from total assets. When out of total assets, total liabilities will be subtracted, whatever is left is the equity of the company. So in the equity, the first thing we have is a contributed capital. The capital that is being contributed by the owners. So owners हमें capital किस form में देते हैं? They give the capital, they contribute in the form of common stock, and they contribute in the form of APIC. देखिए आप जब शेयर्स इश्यू करते हो, normally they will be giving you the face value, they will be giving you a security premium. Let me say there is a stock having a par value of $10, and we issue the stock at $15. So $5 is going to be the APIC, additional paid in capital. So $15 is going to be a contributed capital. It is going to be a contributed capital. So whatever the capital we are getting from the owners, when they contribute the money, whatever the money I'm getting from the owners is a contributed capital. We get $10 in the form of par value and $5 in the form of APIC, which is security premium. So that is going to be a contributed capital. So in the contributed capital, we include two things. One is the par value of the common stock, and the second is security premium, which we usually call it as a additional paid in capital. In excess of par. अगर इसका पूरा नाम लिखते हैं, it is additional paid in capital in excess of par. Okay, so contributed capital include the value of common stock and the value of APIC, additional paid in capital. The second thing we have is a retained earnings. What is the retained earnings? Retained earning means whatever the profits earned by the company, and that will be reinvested within the organization. Not distributed to the owners, but it will be reinvested. Just like in India, we have a reserve and surplus. So whatever the profits we earn, we keep the profits within the reserve and surplus. In the same way, whatever the profits we earn, we keep it within the retained earnings as reinvested capital. The third thing we have is the accumulated OCI. So whatever, like we discuss about the comprehensive income, in comprehensive income, we discuss net income and OCI. So whatever the other comprehensive income we have, it keeps on accumulating within the equity side of the balance sheet. OCI accumulated till date will be the part of accumulated OCI. And the next is non-controlling interest. Anyone have an idea what is the NCI? What is the NCI?
Minority interest in holding company or something like that.
Absolutely. Minority interest in the subsidiary company. Non-controlling means like A company acquired B company. Okay, let me say A company acquired 60% interest in B company. So 60% is known as controlling interest. And whatever the interest they have not acquired, like 40% interest is going to be the non-controlling interest. So whatever the interest we control is a controlling interest, and whatever the interest we do not control is a non-controlling interest. So that is also the part of equity side of the balance sheet. Any doubt within this point?
Sir, if it is not acquired by the acquiring company, then how can it come under the equity of that company?
Sorry, your voice is cracking. Can you please repeat once again?
Am I audible?
Yeah, you are audible.
I'm saying if the acquired company has not acquired the remaining 40%, then how come it comes under its equity?
That is something I'll explain you once I come to that chapter. In the consolidated financial statement, I'll explain you why it is the part of equity side of the balance sheet. I'll explain you at that time, because if I give you the idea now, I have to explain the entire topic in detail. So we have a chapter by the name of consolidated financial statement. In that, I will be explaining. So,
Okay,
but
sir.
I can say you one thing. Whatever the share we have acquired is something on which I have a control. So that's why I call it as a controlling interest. And whatever the share I have not acquired, that is something lies with the other means those who have those shares are mainly they have a minority interest in a company, and they do not control the entire organization, but yes, they have the percentage rights within the company. So that's why we keep it in the equity side. But why we keep it in the equity side, that is something I'll explain you at that time. So now, before I move to any other thing, I'll be taking few questions related to the first point we have completed, because it's equally important that we should do the questions related to what we have completed. Okay, so we have the first question. So trial balance is there in which we have a debit side and credit side balances there for cash, AR, prepaid taxes, accounts payable, common stock, APIC, retained earning, foreign currency, translation adjustment, revenue, expenses, a lot of things we have. Then they are giving some additional information like during year 6, estimated tax payments of 300,000 is being there that were charged to the prepaid taxes. Tray has not yet recorded the income tax expense. There were no differences between financial statement and income statement income. They have a tax rate of 30% is being there. Then AR is included in AR is 500,000 that is being due from customer. Special terms guaranteed to this customer requires payment in equal semi-annual installments of 125 every April and October. So they are asking you to calculate the total value of the current assets. Please take 1 or 2 minutes. Guys, they are asking us to calculate the total current assets. Anyone have calculated it? Great, we got the first answer, option C. So we have a 3 current assets. One is cash, one is AR, the third is prepaid taxes. But for AR and prepaid taxes, we have the working notes. So during year 6, estimated tax payments of 300,000 were charged to the prepaid taxes. Okay, so Trey has not yet recorded income tax expense. Income tax अभी तक record नहीं किया. So how much income taxes will be there? So 3.6 million is the revenue, 2.6 million is the expenses. So pre-tax income is 1 million. And 30% is the tax rate. Sorry. Is 1 million. 30% is the tax rate. So 300,000 is the income tax expense. So Trey has already 300,000 in the estimated taxes, we can say, which is currently sitting in the prepaid taxes. So actual tax expense and the prepaid balance both are matching. So it means I would say this will be offset. Whatever the tax I have to pay, whatever the tax is there in the income tax expense, that is something both are matching. So because this actual tax expense matches this amount exactly, so we can say the entire 300,000 prepaid balance is offset to record the tax expense. Now, the second point is AR. And one more thing is there, that financial statement and income tax income both are same. There is no differences there, so no deferred tax asset or deferred tax liability will arise. Next is included in the AR is 500,000, which is due from the customer. Special terms granted to this customer require the payment in equal semi-annual installments. So first payment will be given on April 1 of this year, and second payment is given on October 1. So we have already received 250,000. And remaining 250,000 we are going to receive in year 7. Okay, so कितना included है? $1.65 million में 500,000 already included है, but 250,000 we have already received. $1.4 million is the amount. So 550,000 plus 1.4 million, I would say $1.95 million is going to be the answer. So I think option B have to be the right answer.
So can you please explain the prepaid tax point again?
See, for prepaid taxes, I would say 300,000 is already there in the prepaid taxes. Prepaid taxes means they have to pay they have paid the taxes in advance. They are saying that. Means they are saying they have paid the taxes in advance. What is the meaning of prepaid? Prepaid means paid in advance. 300,000 we have paid in advance. But if you can see, 300,000 they have to pay in the current year. So 300,000 they have to pay in the current year. So how it is in advance? It is not in advance, because whatever they are saying in advance, that is going to be adjusted in the current year, because for the current year, if you calculate the tax liability, it is going to be 300,000. And that tax liability is already being adjusted with the prepaid taxes. When it is already being adjusted with the prepaid taxes, then what is the point of prepaid tax? Nothing, it's zero. यही अगर pre-tax income is 1 million into 30% is there. If it is less than 300,000, let me say 300,000 is the prepaid taxes, and here I am getting 200,000. So उस case में I can say 100,000 is the prepaid taxes. But यहाँ पे entire amount is there going to be an income tax expense. That's why I am assuming the prepaid taxes as zero. Let me explain it in more clear terms. Okay. So 300,000 हमारे पास prepaid taxes में. What it shows? It shows an advance taxes we have paid. It shows an advance taxes we have paid. कितने? 300,000. So it is a current asset. That's fine. But year 6 में साफ साफ लिखा है that whatever the 300,000 of the prepaid taxes is there, that is something is the estimated tax payments. Okay, so now the next thing that is being Trey has not yet recorded the income tax expense. ये clearly specified है. मतलब income tax expense अभी adjust नहीं हुआ. If it is not being adjusted, so we have to adjust it now. So what is the amount of income tax expense? So revenue is 3.6 million. Expenses is 2.6 million. So 1 million is going to be the income. इसका 30% निकालूंगा, how much we are getting? $300,000. So that is the income tax expense. 300,000 is the prepaid one, and 300,000 we have to give it to the government. So 300,000 already दे चुका हूं, 300,000 देना भी था. So कितना prepaid taxes हो गया? Zero. So that's why I'm taking it as zero.
So, like, we cancelled out the 300,000 prepaid tax with the we already which
Yeah,
we
we
already had
cancel
paid.
out the prepaid taxes with the income tax expense.
And the other 300 was the income tax we need to pay. We don't have any
Yes.
prepaid for that.
Yes. Because it's clearly given, it is not being paid yet. So that is something we have to pay it now.
So, what does this 9 means? There was no difference between financial statement and income statement.
See, we usually prepare to, we calculate the income as per income statement as well. We calculate the income as per, for the income tax purpose separately as well. So when there is a difference between the financial statement income and the income tax income, so it ultimately lead to the deferred taxes amount, deferred tax asset or deferred tax liabilities. So this is something they are talking about. But here there is no deferred tax. Why? Because ultimately both of these incomes are same. So that's why there is no deferred taxes there. Everyone is clear now?
Yes, sir.
I want a quick thumbs up, everyone.
Yes, sir.
Great. Yes. Let's move to question number 2. On December 31st, year 1, the company had a note payable due on August 1. Year 2, on January 20, year 2, Paxton signed a financing agreement to borrow the balance of the note payable from a lending institution to refinance the note. So the agreement does not expire within 1 year and no violation of any provision in the financing agreement exists. So on February 1, year 2, the company was informed by its financial advisor that the lender is not expected to be financially capable of honoring the agreement. So financial statements were issued on March 31st, year 2. So how should Paxton classify the note on its balance sheet at December 31st, year 1? Yes, what's your answer? Option B. Great. Whatever is your answer, right, wrong, it doesn't matter, but at least give a try. Option C, option D. Okay. So let's go through to this now. More students are saying option D, but let's quickly go through to this once. So what they are asking, first of all, they're asking how should the company classify the note on its balance sheet? So as per US GAAP, a short-term obligation is something that will be due within 1 year. Okay. So it can only be reclassified on a non-current if the balance company demonstrates both the intent and ability to refinance. अगर within 1 year due है तो it's a current liability. But if the company demonstrates that yes, they have the intent and ability to refinance the obligation with a long-term note, long-term basis, then only they can consider it. So here it is clearly given. December 31st को we have a note payable that is due on August 1, year 2. January 20, year 2 को company signed a financing agreement to borrow the balance of the note payable from lending institution. So the agreement does not expire within 1 year and no violation of any provision in the financing agreement exists. But it's clearly given on February 1, year 2, Paxton was informed that by its financial advisor that lender is not expected to be financially capable of honoring the agreement. मतलब रीफाइनेंस होने के चांसेस बहुत कम हैं. Option B is the right answer. Why option D is the right answer, I don't know. Because it is a current liability, but financing agreement is not signed after the balance sheet date, where it is written. It is signed on January 20. It's not signed after December 31st. Sorry, it is not signed after March 31st. Financial statements were issued on March 31st, and this financing agreement is signed on January 20. So how option D is the right answer? Everyone is correct. It's a current liability, but the reason is not correct. Only one answer I got as B. So option B is the right answer. It's clearly given. If you read this question carefully, you'll automatically have the answer. Is this clear? Yes. If financial year end for the company is December or March, but still option B will be the right answer. Option D will never going to be the right answer. Option D is the best option, I would say. Because the lender is not capable. This is one of the best reason that it's a current liability. Yes, Sumit, Renu, Gunjanjeet, everyone, is this clear? Swati?
Sir, I have a question. But
Yes,
we
please.
got to know after 31st December that he's not capable of honoring the agreement. Then how could we take this reason as answer?
Can you please repeat once again? Sorry.
The company got to know that lender is not capable of honoring the agreement after 31st December. But we are
Yes.
making the balance sheet for 31st December, then how can we take the, this reason as the answer?
Oh, okay. See, normally, closing date and issue date both are different. Closing date and issue date both are different here. Closing date is 31st December, issue date is March 31st. If you already have an idea before issuance of the financial statement, you already get an information. So in that case, you have to consider it as a current liability. But if suppose issuance date is 15 February, or let me say issuance date is 31st January, in that case, your answer is going to be it's a long-term liability, and option A will be the answer in that case. Kind of subsequent event, uh, yes, you can say whatever the event that is happening after the balance sheet date, but before the issuance of financial statement, it will be like that. So if in the question it is like they're changing the date, like they are saying on January 31st is the issuance date. In that case, it will be treated as a long-term liability. But just like in this question, we get the information after the balance sheet date, but before the financial statement issuance date. So ultimately, that's why we treat it as a current liability. Because we already have the information about this. We have another question which is very, very simple, but very, very important question. Included in leak operations liability account balances at December 31st, year 4 were the following: 14% note payable issued October 1, year 4, maturing on September 30, year 5. 16% note payable issued on April 1, year 2, payable in 6 annual installment of 50,000 beginning on April 1, year 3. Lee December, year 4 financial statement were issued on March 31st, year 5. On January 15, year 5, the entire 200,000 balance of the 16% note was refinanced by a long issuance of a long-term obligation payable in a lump sum. In addition, on March 10, year 5, Lee consummated a non-cancelable agreement with the lender to refinance 14% $125,000 note on a long-term basis on readily determinable terms that have not yet been implemented. Both the parties are financially capable of honoring the agreement. There have been no violation. On December 31st, year 4 balance sheet, the amount of note payable that Lee should classify as a short-term obligations. Good question. Guys, have you done it? Option A. Again, I'm saying read the question carefully. Take your time, take 1 or 2 more minutes, but make sure you are reading it carefully. More answers, please. Yes, Swati, Sumit, Gunjanjeet. Sorry. C option is the right answer. Why? Because both the loans are going to be refinanced with the long-term loan, and that will be even it is both the parties are financially capable of honoring the agreement as well. So that's why option C is going to be the right answer. Great response, everyone. We are not doing this. Okay, here we have a next question. The company has 1 million of the notes payable, which is due on January 15, year 2, at the financial statement date 31st December, year 1. The company signed an agreement to borrow 1 million to refinance the notes payable on a long-term basis. Financing agreement called for borrowing note to exceed 80% of the value of the collateral the company was providing. At that date of the December 31st, year 1, the value of the collateral was 1.2 million, as was not expected to fall below this amount during year 2. How much amount should be classified as a note payable? $40,000 and $960,000. Okay. More answers, please. Everyone is with option D. I don't know why option D is the right answer. So here the company demonstrates their intent and the ability to refinance the short-term debt using a financing agreement. The amount that can be excluded from the current liability is limited to the maximum amount available for refinancing. The maximum amount. The financing here, the collateral constraint is also there. The financing agreement explicitly restrict The borrowing to not exceed 80% of the value of the collateral. And what is the value of the collateral is?
1.2.
1.2 million.
Oh,
And that
1.2.
should be multiplied with 80%. So that is 960,000,
Hmm.
right? Okay. So absolute cap is for $1 million. So our financing. So let's try option D then. Yes, absolutely correct.
No.
So I don't know why, Renu, have you have changed your answer?
Actually, I thought it says the collateral value is restricted to 80%. But
Yes.
since the refinancing has happened, collateral only triggers if there is a default or something anticipated. His liability of 1 million still remains as a long term because he has refinanced the entire amount.
But the question is clearly indicating that borrowing not to exceed
Not to exceed.
80%.
Yeah, got it.
It means whatever the $1 million we have to pay, 960 is refinance and 40,000 we have to pay on the given time.
Okay. Earlier, I had applied that logic, but then somehow I thought that maybe his intention is.
More we understand, higher is the chances of getting
Yeah,
wrong.
like you start breaking the questions word by word, then.
Refinance करा रहा genuine person दे देते हैं पूरा लोन.
Yeah. And we put a note that he will pay when due.
Okay, so let's do one more question and then we'll start with the next topic. Okay. So Bright Corporation had the following liabilities at December 31st, year 6. AP we have of 55,000. Unsecured notes 8% due on 1st July, year 7 is 400,000. Accrued expenses we have of 35,000. Contingent liability we have for 450,000. Senior bonds 7% due on 31st March, year 7 is $1 million. So contingent liability is an accrual for possible losses on 1 million lawsuit filed against the Bright. So Bright's legal counsel expects the suit to be settled in year 8 and has estimated Bright will liable to pay the damages in the range of 450 to 750. Deferred tax liability is not related to an asset for financial reporting and is expected to reverse in year 8. So they're asking us to calculate the current liabilities. So for contingent, first of all, you just read this question. Then I'll give you the idea, I'll give you the explanation about the contingent liability, how it should be treated. But other than that, I feel everything is simple. $1.49 million. Okay. So the first is accounts payable. It's always going to be a current liability. Accounts payable is always going to be a current liability that is valued at 55,000. Then we have a unsecured notes that is 8% that is due on 1st July year 7, which is 400,000. So that is again due within 7 months. So it's a current liability. Then we have accrued expenses. Again, accrued expenses is always treated as a short-term liability, a current liability, we can say. Then we have a contingent liability, which is $450,000. But a clear point is being specified that bride's legal counsel expect that this suit is going to be settled in year 8. It is going to be settled in more than 1 year. Year 8 is going to be more than 12 months. So it's a non-current liability, not a current liability. Then a deferred tax liability. What do you think? It's a current liability or non-current liability? Deferred tax asset and deferred tax liability is, just keep it in
Non-current.
your mind, it's always non-current. DTA is a non-current asset and DTL is a non-current liability. If nothing is specified, it's a non-current liability. Senior bonds, that is 7% due on 31st March year 7. It's a current liability. So 55 plus 400,000 plus 35 will give us 490 plus 1 million. It's 1490000. Option B is the right answer. Great, guys. Is this clear, everyone? Great. We have not discussed anything related to stockholders' equity. Okay, let's do this last question. Guys, I think the next topic, next subunit will start in the next session because we are about to, like, it's only 15 minutes being left. We'll start with the next topic in next class. So a company's year-end comparative statement of the financial position reflects the following changes from the prior year. Cash increased by 70,000. Current liabilities increased by 42,000. Non-current liabilities decreased by 10,000. All other assets decreased by 75. Which of the following statement is correct regarding the current year change in the company's stockholders' equity? Great. Quick response, Sumit. Option C. So asset is equal to liabilities plus equity. So cash is being increased by 70,000. Liabilities increased by 42, decreased by 10, decreased by 75. So assets के अंदर कितना change है? 70,000 plus
Sir, assets is decreased by 75,000.
assets is increasing, I think.
Last point. Assets decreased by 75.
Okay, yes. So 5,000 होगा ना फिर. It will be decreasing by 5,000, right?
Yes.
And liabilities कितने से कम हो रही है?
ये 75 रिमूव करना होगा आपको.
Okay. Yes, sorry. So liabilities will be increasing by 32. So it means equity is decreasing by 37. How? क्योंकि when I take this to the other side, minus 5,000 minus 32,000 is equal to equity. So equity balance is going to be minus 37,000. So option C is the right answer. It's perfect. Let's quickly solve this question. Question number 17. A company has the following liabilities at the year end. Mortgage note payable 16,000, which is due within 12 months. Short-term debt that the company is refinancing with the long-term debt. DTL arising from depreciation.
Long term.
It requires this much time. We already know DTL is not a current liability, and short-term debt when finances through long-term debt, it is not a current liability. So only 16,000 that is due within 12 months in the mortgage note payable is going to be a current liability. So C option is the right answer. Great, perfect. It's the same question we have. Question number 1. In question number 1, they are asking you to calculate the total current assets. It's the same question. Now they are asking you to calculate the total retained earnings.
What they asking? What would you put in retained earnings? Retained earnings 36 minus 26, 10 minus 37. 630. 1430.
Quick response D. So when I'm talking about the retained earnings include the net income. Net income after tax. Net income we have calculated is 3.6 million. minus 2.6 million. That is $1 million. And after paying the taxes of 30%, what is being left is 700,000. This 700,000 is being added to the retained earnings. Already retained earning is 630,000. Now when the 700,000 will be added,
It's 13,000.
so 1330,000 is going to be an answer. So option D is going to be the right answer. Simran, sorry, Gunjanjeet, can you please let me know how you are getting option D, or is there any doubt you have here in this question?
Text.
No, sir, it is clear now.
It's clear now? Great. So in the next class, we are going to start with. So in the next class, we are going to start with the statement of income. Okay. So we'll start with the next subunit in the next class. So for today, I think we should end our session for now, and we'll start with the next topic in the next class. Okay. Yes, guys, I'm sharing my number here. If you have any doubt, like if you face any difficulty in anything, you can directly reach out to me. This is my WhatsApp number, and you can also call me on this number. So thank you, everyone. Thank you for your time.
Just one question quickly.
Yeah, please. Yeah, please.
So before the session, so do we need to refer to any course material to go through this? Like when you covered the questions like issue date of financials and the financial statement closing date. So that while in the session we were not talking about, but in the question we had all those pointers coming in.
Yeah. Pointers, you will get it in the question. So you can do one thing, like whatever the topics we are covering in the class, like tomorrow we will be covering like two topics, mainly the statement of income and the comprehensive income. These two topics most probably we cover in the next class. So what you can
Okay.
do is you can like if you want you can come up with like have a quick reading with these two topics, because once you
Okay.
read it you will be easily able to understand everything. But in the questions I always say in questions we find out something extra, because
Okay.
why I'm saying that we will not do the simulation, because simulation have more detailed things about that, because
No, which is fine. Yeah.
whatever we have not completed, just like we get the topic of contingent liability, that is
Yeah.
a separate chapter.
Yeah.
Subsequent events is a separate chapter, but it's still some glimpse we will be getting. So we keep on discussing, because ultimately that is not covered in the chapter, but we keep on discussing with the questions as well. That's fine. But you can come up like those who have the GLIME material, please revise the next 2-3 topics. And those who have the Becker, you can revise the topics like a statement of income, or you can revise the topic of comprehensive income, a statement of changes in equity. These basic topics you can revise when you're coming for the next session.
Okay. Yeah.
So thank you, everyone. Thank you for your
Thank
time.
you.
Bye-bye.
Bye.